All right, guys, we ended the week pretty strong on Friday. Now, take a look at these charts. We have silver above $24, just above in general, but it's at 24.16. We have gold at 18.17 and 81 cents. Now, a lot of people over the course of the last couple of weeks were saying pretty bearish things about gold, but here on this channel, I've been saying a lot of bullish things, not just because I wanted to pump it up or anything, but given the fact that my forecasting models, technical analysis, and fundamentals were pointing towards more of a bullish move, I personally was just kind of like, you know what? I know a lot of people are saying things are looking kind of rough, but in my view, things look like they're moving pretty positively. And this is what we've been seeing over the course of the last week, though we have had some potholes. And I've pointed them out and I've said that these things will not last that long. And we're pretty much on a trajectory of pushing us ahead. So in this episode, what we're going to do is we're going to look at an article talking about some of the things that we can expect based off some fundamentals. And there are some things that I have some issues with in that article, and I'll point to why. And also, we're going to do our own forecasting using my forecasting models to show you where I'm kind of looking and what kind of ranges I'm looking at for gold, silver, and even copper. But before we get into any of that, please hit that subscribe button right down below. Again, I give my own independent view on things, and it looks like, pretty much it's playing out. So if you're interested in hearing that, hit that subscribe button down below. Helps the channel out. Also, please hit the like button. It helps get this video out to more people who might be interested in gold and silver. So this is pretty much the crux of what I was looking at in yesterday's video, which is the 20, 60, and 253-day moving average. In fact, I even kind of brought it up yesterday in a tweet to Peter Schiff, who said the following: the Fed announced the taper and gold didn't go down. The October jobs report came out stronger than expected, and not only didn't gold drop, now it's up over $20 per ounce at 18.14. This is the first stronger than expected jobs report that gold shrugged off. The sellers are gone. And then I followed up and added, employment cost index is looking strong. Inflation will follow suit. Gold also looks poised to have a nice golden cross in the next couple of weeks. And this is pretty much what you saw in the last chart that I showed. And this is what I'm seeing. 253 is dropping pretty aggressively. 20-day is rising pretty aggressively. It's only a matter of time before we see that bullish sign. And a few people liked it, but then one person said 1760 inbound, which I don't think so. I don't think we'll see bearishness. I think we have more of a probability of seeing bullishness than bearishness at this point. And if you're on Twitter, follow me at Investing with TJ. So let's see what some others have to say regarding gold and silver. So this is an article on Kitco titled "Gold Price Jumps Nearly $25. Is this the start of a breakout?" Now, I wanted to talk about that because silver will usually lag behind gold. So if gold does well, then we know it won't be long before silver does. So let's see exactly what this person had to say. And again, I had some issues with some of the things that they said. But let's start. The intraday volatility for gold has been on the rise. The market is trying to digest how hawkish the Fed actually is. Powell's comments left plenty of wiggle room to walk back that hawkishness. The central bank is more likely to stay patient to help the economy, which is positive for gold. The Fed might wait longer for rate hikes, or it might even stop its taper for QE. And let's go down here. On the economic side, gold rallied despite the U.S. economy adding an impressive 531,000 positions and the unemployment rate dropping 4.6% in October. In my view, that's actually good for gold. But here's one of the reasons why someone says it's not. And they actually think that, this won't continue. let's continue. And this is a quote from this person, Melik. That essentially means that the labor force participation rate is still at problematically low levels, and we are nowhere near full employment. This is why markets are not pricing in the probability of Fed's tightening as imminent. Plus, it is doubtful that the strong job growth pace will continue for the next 6 months or a year. Now, for me, I look at the employment rate, and I also look at something called the non-cyclical rate of unemployment, which basically shows where we should be regarding unemployment, because there's always going to be some level of unemployment within the country. But it should be lower than where we are right now. Currently, unemployment is around 4.6. The natural rate or cyclical, the non-cyclical rate of unemployment is at 4.2. So we're not too far off, especially given the fact that we were above 5 not too long ago. I think almost like a month or 2 months ago. So we're closing that gap. And going back to what I said before in this tweet to Peter Schiff, that plus the employment cost index getting stronger and jumping up is actually going to be a boon for inflation, which will be a boon for gold, which will be a boon for silver. And looking at the employment cost index, and I showed this in yesterday's video, check that video out. The employment cost index spiked aggressively in Q3, and we got those numbers at the end of October. So that also has likely been helping gold out. So we got those numbers at the end of October, and more people are getting jobs. Now, I do agree that the pace of employment will likely not increase at these fast levels because we are closing in on that non-cyclical rate of unemployment. We're just not going to keep increasing at that fast rate, though I do think we will eventually fill that gap. So let's take a look at where silver could be given some inputs using my forecasting model. So let's scroll all the way back here. We're going to start with gold. We're going to go to silver. And then again, we're going to throw in copper. So this is where we would be for CPI, though I will say this is going to be an underestimate. Why? Because these numbers are based off of data going back to 2014, meaning that the rate of increase in the last couple of months have been way more aggressive. So this will likely be a little bit less than what we will see for CPI, which is coming out next week. So stay tuned for that. This is where we are currently right now for real yields, and I wouldn't imagine it being too, less than this or more than this. I assume we're going to be averaging around -1 for some time. USM2, this is where we'll be given 0.73% increase. This is where I think we'll be at the end of the month, given GLD volume currently. And this is where I think we will be for dollar futures, just averaging around 94. Currently, we're at 94.2. And this is where we may wind up for the Fibonacci, for the next Fibonacci level once Bitcoin continues going down. I do think Bitcoin will display some weakness in the coming days. I don't think it'll be, long lasting, but I do think in the next couple of days, we'll see some weakness in Bitcoin. And that would bring us to around 1835. Now, mind you, if we take this and put this here, and take this and put this here, these are the current numbers for dollar futures and Bitcoin. That brings us to 1817.26, which, funny enough, 1817.81 is the current price of gold. So in case you're wondering, well, how accurate is this thing? That's how accurate it is. So playing around with these numbers, throwing 94 in there, throwing 57,700 in there, we might hit around 1835.77. And again, funny enough, if we scroll down, what you'll see here is that around 1833-ish or so is that last near-term high that we had before falling back down. So that's going to be the next level of resistance as far as price action is concerned, and even as far as my forecasting model is concerned. So let's take a look at silver. Again, 274.6, negative 1.03. I threw in 1835 for the new gold. 428 million is what I expect SLV volume to be. We have it at averaging around 94, and at 57,700, that means that we may actually drop to $24.03 for silver. So again, hitting that level of support that we're trying to establish right now. And I see that pretty much because Bitcoin, is moves in lockstep, not in lockstep, but pretty much in the same direction as silver, even in a multiple regression. That same thing doesn't happen with gold, even though they have positive correlation. When you put it in a multiple regression, it actually has an opposite effect. So we have that. And just for fun, here is copper. And copper, we include Caixin manufacturing PMI. We also have crude oil, DXY futures, and Chile exports. I haven't done a lot of data on what we could expect for the rate of growth for some of these. But if we just put in 94 here, see what happens. Nothing. So pretty much a lot of the movement from copper does depend upon Chile exports, Caixin manufacturing, crude oil. The reason why we use these is because Caixin, they're the customer, China's the customer, Chile is the provider, supplier, and there is a nice correlation with oil as well and the dollar. So this is what we could possibly expect moving ahead for copper, this range here. So guys, let me know what you think about all this in the comment section below. What are your forecasts? What are your price targets for silver in the coming weeks or even in the coming month? And hit that subscribe button, hit that like button. Thanks again for watching.